Thanks for joining and welcome back to Wall Street Silver. Our guest today is Clive Thompson. Clive has had over 47 years in career in trust, wealth management, and Swiss private banking. Clive, welcome to Wall Street Silver.
Thank you very much, and it's great to meet you, Ivan. I've been retired for 3 years now, nearly, so it's 50 years of experience in investing.
Oh, wow, that's a long, long time. It's such a huge pleasure having you come down to Wall Street Silver. This is your first time. I wanted to get you on to speak about everything that's happening in the gold, silver, precious metals market. First, let's start off with gold. Gold in 2024 has really taken off, and silver was late to the party but is following behind. Where do you see gold going? Yeah, where do you see gold going from now to the end of 2024?
Well, I feel I'm very much in tune with the gold market. I first came to own some gold at the age of something like 13 years old when I
Wow.
received a gift of a gold sovereign from my grandfather. He told me to keep it forever, and I still have that gold sovereign today.
Wow.
Uh, he also asked me to tell nobody. I just think I just broke that rule. Um, but we back then in the UK, we had taxation rates of 87.5% on income,
Whoa. Oh my
plus,
goodness.
and well, it's worse than that because it was an extra 15% on top of that if you had investment income, which took your tax rate to 102.5%.
So how did people
Uh,
survive?
well, there was something called the brain drain, which basically meant that anybody who had any brains left for America. But that lasted about 3 or 4 years with those in excess of 100% tax rates, and I mean, it didn't affect the poor. But if you earned, it affected anybody who had more than £12,000 of income. So
Wow.
that's not exactly a millionaire status,
Yeah, it's
of course.
everyone.
Because yeah, I mean, well, I mean. To put that in perspective, you'd be hard pushed to get anything like that as a salary as a beginner. I remember my first salary in 1975 was £950 a year.
Wow.
Uh, so it wasn't anything like the £12,000, which was going to hit those high rates.
Wow, what a change. Now, you've been in the gold market for so long. Since 13 years old, you've had your first gold sovereign. And what made you kind of continue your career and your love for gold and silver?
Well, in the 1970s, I was working for a firm called Kleinwert Benson in London. That's a wealth manager. And in the same building, there was a gold dealer called Sharps Pixley. I think they're still around today. And I took my sovereign down to them to see what it was worth.
Uh-huh.
And was quite, it's a one, don't forget, a sovereign is a British coin. It's a £1 coin made of gold. It's nearly a quarter of an ounce of gold. Uh, so I didn't know much about it. It's just for me, it was just a coin. But as Sharps Pixley had the word gold dealers or something like that on the door, I thought I'd go and ask them. And I took it into them and asked them what my £1 coin was worth. And they said, "Oh, we'll give you," and I can't remember the figure, maybe 15 or £20. And I was gobsmacked. I thought, 15 quid for a £1 coin. This is too good to be true, But I didn't take the offer. But what I did do was start walking around the banks asking if they'd change my £1 notes into sovereigns. And of course,
Oh.
there was no bank. If any bank did have any sovereigns, they weren't going to sell them to a spotty 20-year-old with a crumpled pound note. But I also went round the flea markets and antique shops, hoping that someone would swap me a pound note for a pound sovereign. But I had no luck at all in that.
Oh, that's very funny.
I was quite interested in the gold price. I started looking up in the Financial Times Daily, and in about 1982, I bought a book by Brad Kettrell it's simply called Gold, but it's about 300 pages with
Wow.
everything you could possibly want to know about gold, including the gold mining companies and literally everything under the sun. And I was hooked. So one thing I noticed in the book was they had a table of gold mining companies and their cost of production in I think 4 or 5 years before and up to date, let's say 1981 or 82. And what I noticed was the cost of production of gold per ounce had risen massively. It was almost double over 4 years or 5 years.
When
And I
was
thought,
this? When was this?
oh,
Sorry,
this
Clive.
would be 1982,
Okay.
82. And I thought, well, that's very interesting. If the cost of gold, mining gold, is going up, I guess the price of gold will have to go up because I'm not going to sell it for less than it cost
Yeah,
them to
yeah,
mine.
of
So I
course.
went along to Sharps Pixley and bought myself a second sovereign, which actually I paid a lot more than 20 quid for. But it was the start of 50 odd years of picking up the odd coin here and there as the opportunities arose. But over the years, because I was watching the gold price every day, and these days, of course, almost every second, it's on my screen in front of me. Um,
Yeah.
I kind of feel that I'm dancing in tune with the gold. It goes up, it goes down. I kind of feel the rhythm. So I feel I've got a very good feel for it. So yeah, let's come on
What's your
to.
rhythm? What's your rhythm now in 2024 right now? What's your feel for it? Up or down?
Well, I wrote on LinkedIn. LinkedIn is where I do my writing. I wrote on
Yes.
LinkedIn about a year ago. It's actually about 8 or 9 months ago that I was absolutely sure that gold was going to smash through the $2,000 barrier, and it duly did within a week or two. Uh,
Wow.
uh, and we're now higher than I expect. I put a year-end forecast for 2000 for this year of 2,300, and
Oh,
we're getting on for 2,500. We're 2,400,
soon
and
soon we're gonna hit 3,000 in another six,
yeah,
7 months.
yeah, we're 2,468. So I passed my year-end forecast. Uh, but of course, it's very dangerous to put a date and a number in the
I
same
know. It's
sentence.
super day, especially with precious metals. Now, Clive, I wanted to talk about your mining article you wrote today on LinkedIn. You wrote a LinkedIn article today on the mining sector. What is it about? What does that article tell? And of course, I'll put a description and a link to your LinkedIn below for everyone. But what is that article, the mining one you wrote today?
Um, I was pointing out the observation I've had for many, many months that the gold mining stocks have massively underperformed the gold sector, and for more than a decade.
Right.
We've seen the gold price since, let's just take 2021 as an example. We've seen the gold price rise by 33.07%. That was this morning. It's a bit more than that now. Um, but the gold mining stocks in the same period are up about half that at 18%. And the junior gold stocks are up about 12%.
Wow.
So they've not kept price with the gold price. And if you think about it, the mining stocks should be moving in the same direction as gold, but much faster. And the reason for that is the leveraged effect, because if the gold mining company's got a cost of production of, let's say, $1,200, and the gold price is 2,000, they're making $800. But
Right.
if the price is 2,400, they're making $1,200. So their profits are going to go up 50%. Therefore, the gold mining, when the gold price has gone up by a mere 20%, you'd expect the gold mining stocks to go up by, say, 50%, suddenly a lot
Absolutely.
more.
Yeah.
And that hasn't happened. They've gone up a lot less.
Right. Do you believe that I know the mining sector, a lot of people have been talking about it. A lot of people in the past like a year have been saying it's underperforming. But do you personally, Clive, do you go after explorations? Do you go after producers? What do you look at when you look at the mining sector for gold and silver?
Um, I'm not a huge fan of exploration. Over the 50 years I've been investing, I can't even begin to tell you how many tips a year I hear about gold mining companies. And I'm pretty sure that most of those tips are for companies which don't even exist anymore.
Oh, geez.
Um, I've whilst when you're younger, you get fooled by these tips, but as you get older, you start to realize the reason you're hearing a tip is because someone wants the price higher,
Right,
and they
right,
might want
right.
the price higher because they're going to run out of money and they won't be able to continue their production, and therefore they're aiming to have a higher share price so they can raise some cash at a higher share price. That would be a good example. Or it
Right.
might be more sinister than that. They want to unload their shares at a higher price, and therefore they're playing the greater fool theory. If I can find someone who'll buy my shares at the higher price, I can unload
Right.
them.
Like
Uh, so
run up the price of the stock and then unload your big amount that you have.
so so it's not to say that every research company looking for gold is a bad one. There's lots of very good ones out there.
That's right.
The difficulty is knowing the wheat from the chaff. And certainly some of those which have been looking for gold in the past have over time become quite big companies. But it's very difficult to know in advance. I mean, the same would apply to the tech sector or the stock market. Who could have known back in the late 90s that Apple would become one of the biggest companies in the world? It was just a computer company which made it wasn't even called the Macintosh, was it? It was called, I forget what it's called now, but they made a gaming, the Apple gaming computer, I think it was
Yeah, I
called.
think it was Apple 1, Apple 2, then they came out with the Macintosh. There was something like that.
But nobody could have picked that. I mean, if you look, even if you looked at Microsoft, and I've got a book called Nasdaq's $1 billion companies from the mid 90s. It describes Microsoft as a company which sells books on computing and also has a software operating system. So who would have thought that a bookseller would become one of the greatest
Yeah, that's crazy.
software companies in the world. When you look at a mining company, you can look at all these companies and they all got their good stories about how they found the mother lode and how it's going to be really great when they get out of the ground. But some of them will run out of money before they get there, and
Yeah.
some of them will make it. And I don't like that sort of guesswork. So prefer to buy the majors, or maybe an easier way if I go to the juniors. The way I have got into the juniors is through an ETF, an exchange traded fund, which holds a collection of these smaller mining companies. So you're not focused on any one. You get a collection of them all and you do whatever they
Like
do.
the SILJ?
That would be like the SLIJ, which is the silver ETF. The one I buy for gold is the GDXJ. It's the
Okay.
Van Eck gold mining juniors sector. So, if you're going to go into mining companies and you haven't got the time to look into their individual characteristics and so on, I think you could go via an ETF and get the whole bunch in one fell swoop.
Hmm.
But if you look hard, you can burrow down and find a lot of statistics about each mining company, and it's possible to draw some conclusions. The sort of things I'd be looking at is: do they have plenty of cash? Are they selling their gold or silver at a higher price than they're mining it for?
Right.
Uh, is their production increasing or decreasing? Those are the kind of things I'd be looking at to draw a conclusion as to whether I'm buying a company which is going out of business or one which is going to continue.
That's true. That's true. Now, I wanted to talk about, central banks, Clive. Central banks have been buying the most amount of gold at record pace in any time, like on record right now. So why do you think central banks are buying so much gold? What do they know that we don't?
Well, they know what we can know, and what we can know and what we do know is that the level of debt in the Western world is likely to spiral out of control at some point in the coming decade.
Right.
If I take the best followed country, which is the United States, where the information is most easily available, we can see that the level of debt is increasing year after year, not only in absolute terms, but also as a percentage of the gross domestic product.
Right.
Um, if we go back about 40 years, when the Maastricht Treaty was signed in Europe for the EU, at that time, it was widely thought that no country should have a debt to GDP ratio exceeding 60%. And most countries, including the United States and the UK, were around 40% debt to GDP ratio, uh, something which was considered to be perfectly manageable for a developed economy.
Right.
But they wrote in a rule saying nobody should have more than 60% if you want to join the EU, because beyond that, we think it's the end of the world, more or less, for your economy. Well, all Western economies, not all, but broadly speaking, they're all well over 100 or at or over 100%. The United States is well over 100%. UK's just gone through 100%, and most of Europe, or the average of Europe, is over 100%.
Wow.
Switzerland, which is not part of the EU, stands out with a very low debt to GDP ratio at 40%.
Oh,
Um,
seriously? It's 40%
yes,
only? Wow.
yes. So they managed to keep it in check.
How did they
But
manage to do that? Did they do that by not joining the European Union and ruining their dollar, or how did they do that?
Well, if being a bit facetious, I guess they could walk down the street and pick up the $100 notes. But because I mean, Switzerland is it is one of the richest countries in the world per
Right.
capita, and salaries are so incredibly high that the joke is that if you see a banknote lying in the street, you wouldn't bother yourself to pick it up. Um, but the reality is the with the highest income per capita, one of the highest incomes per capita in the world, they're collecting a decent amount of taxes. And taxes aren't cheap here for those who've got money. I mean, we're talking about, for the average citizen, probably about 30%, but for the rich, it's at least 50%, if you include what we have, which is called wealth tax. So, they're collecting a fair chunk of change from a population which is earning well above the world average. And that allows them to pay their bills without increasing their debt.
Wow, that's incredible. And, it's I was completely shocked that Switzerland has a 40%, the debt ratio. Like US, do you think they're spiraling out of control to the point where they can't kick the can down the road any longer?
I think there's many ways in which they will try to continue the game of kicking the can down the road. But what you have to remember is every time the US government goes deeper into debt, they're going into deeper into debt so they can spend that money. When they spend that money, someone out there gets richer.
Right.
That's inflation. That's inflation. You're putting money into the hands of the public, whether it be companies, foreigners, or Americans. You're putting that money into the hands of the public at large, and they're going to invest that money in the stock market. They're going to invest it in gold. They're going to invest it in works of art. They're going to invest it in luxury goods there. They're going to invest it in anything that they happen to think will go up in value, especially
Right.
things which are desired, anything which is desired and relatively difficult to get your hands on, or, well, when I say in limited supply. So that's why the price of just about anything which is tangible, including property, has been going up for decades. You take virtually any tangible asset on the planet, whether it be a Leonardo da Vinci painting, and compare with the price today with the price 20 or 30 years ago, and you'll find it's many, many multiples of that old price, and certainly a much higher increase than the official rate of inflation,
Yeah.
which we all know is not really the true rate of inflation.
Yeah, that's right. The true rate of inflation could be 10, 15% with these underreported numbers. You never know the truth. Clive, I just wanted to say thank you so much for coming down to Wall Street Silver. This is your first time, and I hope it's not the last, because what a breath of fresh air. As the market develops and the gold and silver market develops, we'd love to have you back on.
Oh, that's very kind. Of course, I'll be delighted and very honored that you invite me.
Yeah, absolutely. Talk to you soon, Clive.